I've watched men lose everything not to manipulation, not to some shadowy cabal, but to a force they never saw coming, themselves. The market isn't rigged against you. It's designed to exploit the one weakness you refuse to admit you have. I learned this in 1907, when I made $2 million in a single day, and again in 1934 when I lost nearly everything. The difference wasn't luck. It wasn't insider information. It was understanding that the market doesn't need to cheat you, you'll do it to yourself for free. What I'm about to tell you will disturb you, because it means every loss you've suffered was preventable, not by having better information, but by having better self-knowledge. The game isn't rigged. You're just playing it wrong. And I know that's hard to hear. I know you want to believe that there's some force out there, some institution, some algorithm, some insider network that's taking your money unfairly. Because if that's true, then your losses aren't your fault. They're the system's fault. You're the victim. You're powerless. And in a strange way, that's comforting. It means you don't have to change. You don't have to look in the mirror and admit that maybe, just maybe, you've been your own worst enemy all along. But I'm not here to make you comfortable. I'm here to tell you the truth. And the truth is this: you've been lied to about how markets work, about what separates winners from losers, about why some people build fortunes while others blow up accounts over and over again. You've been taught to look for external enemies when the real enemy has been inside your own head this entire time. Now, before we go any further, I need you to understand why this video even exists. Why am I taking the time to tell you this? Because I've lived through more market cycles than most people will ever see. I've made millions and lost millions. I've been celebrated as a genius and ridiculed as a fool. I've stood at the top of the financial world and I've fallen to the bottom. And through all of that, through every victory and every defeat, I learned something that most traders never figure out. The market isn't your adversary. It's not plotting against you. It's not designed by evil men in dark rooms to steal from the little guy. The market is simply a machine, a perfect, ruthless, emotionless machine that does one thing extraordinarily well. It takes money from people who can't control themselves and gives it to people who can. That's it. That's the whole game. And once you understand that, once you really see it clearly, everything changes. You're watching this video because somewhere deep down, you know something's wrong. You've been trading maybe for months, maybe for years, and the results aren't what you expected. You do your research, you study the charts, you read the news, you follow the experts, and still, somehow, you keep losing money. Not always. Sometimes you win. Sometimes you have a great week or even a great month, but over time the trend is unmistakable. Your account is shrinking, and you can't figure out why, so you start looking for explanations. Maybe it's the high-frequency traders with their microsecond advantages. Maybe it's the institutions with their massive resources and insider access. Maybe it's the market makers manipulating prices. Maybe it's the Federal Reserve propping up bad companies. Maybe it's the whole damn system rigged from top to bottom against the average person trying to make a living. And I'm telling you right now, you're looking in the wrong place. Not because those things don't exist, some of them do, but because they're not why you're losing money. You're losing money because of decisions you're making, patterns you're repeating, emotions you're acting on, and psychological traps you're walking into with your eyes wide open. This video is going to do something most trading content won't do. I'm not going to give you a strategy. I'm not going to show you a chart pattern or a technical indicator or a secret formula. I'm going to show you the invisible machinery, the psychological architecture that has been extracting money from your account since the day you started trading. And more importantly, I'm going to show you how to dismantle that machinery. What you're about to learn is the result of a lifetime spent in the market. Not a lifetime of success, a lifetime of learning. Because my successes taught me less than my failures. My victories made me feel smart. My defeats made me wise. And wisdom, in the market, is worth infinitely more than intelligence. Here's what makes this different from everything else you've consumed about trading. I'm not going to tell you what to think. I'm going to show you how to see. There's a massive difference. Most people come to the market with opinions. They think they need to be smart, to outsmart the market, to predict what's going to happen next. That's not trading. That's fortune telling. And fortune tellers go broke. Real trading, profitable, sustainable, wealth-building trading, comes from observation, not prediction. It comes from discipline, not brilliance. It comes from patience, not activity. And most crucially, it comes from self-mastery, not market mastery. You'll never master the market. It's too big, too complex, too influenced by forces beyond your comprehension. But you can master yourself. And in the market, that's the only edge that matters. So here's the core insight, the central truth that everything else builds on. The market doesn't need to be rigged against you because you're already rigging it against yourself. Every single day, in ways you don't even notice, you're making decisions that guarantee your losses. You're following patterns of behavior that have destroyed traders for as long as markets have existed. And you're doing it unconsciously, automatically, because no one ever taught you what's really happening. Let me give you an example. You buy a stock because you believe it's going up. You've done your research. The fundamentals look good. The chart looks good. Everything points to upside. So you buy. And immediately, within hours or days, the stock starts to fall. Not collapse, just fall. Slowly, steadily, a little bit every day. What do? If you're like most traders, you hold. You tell yourself, it's just a temporary pullback. You tell yourself the fundamentals haven't changed. You tell yourself that the market is irrational and will eventually recognize the value you've recognized. You might even buy more, averaging down. They call it because now the stock is cheaper, and therefore a better deal. Days turn into weeks. The stock keeps falling. Your small loss becomes a moderate loss. Your moderate loss becomes a significant loss. And now you're trapped. You can't sell because selling would mean admitting you were wrong. It would mean taking the loss, making it real, crystallizing the pain. So you hold. You hope. You wait for it to come back. Meanwhile, there's another stock you were watching. You didn't buy it because you weren't sure. But now it's moving. It's going up fast. Other people are making money on it. You're missing out. So even though you're sitting on this losing position that's occupying your capital and your mental energy, you're also experiencing the agony of watching opportunities pass you by. Eventually, one of two things happens. Either the stock comes back not all the way, but enough that you can get out near break even, and you exit with relief and a vow to never let it happen again, or the stock keeps falling until the pain becomes unbearable, and you capitulate at the worst possible moment, right before it finally reverses. Does this sound familiar? It should. It's the single most common pattern in all of trading. And here's what you need to understand. This pattern isn't random. It's not bad luck. It's not manipulation. It's the predictable result of how human psychology interacts with market mechanics. You bought based on hope, not evidence. The stock was supposed to go up, not actually going up. When it started to fall, your ego engaged. Admitting you were wrong felt like failure, so you reframed the situation. You turned a trade into an investment. You turned a loss into a paper loss, as if that distinction means anything. You held on because letting go hurt more than watching the loss grow. And this is where it gets really important. The market doesn't care about your feelings. It doesn't care that you bought. It doesn't care that you believe in the fundamentals. It doesn't care about your hopes or your plans or your need to be right. The market is simply expressing supply and demand in real time. When a stock falls, it's not being manipulated. It's telling you that there are more sellers than buyers. That's it. That's the message. And your job as a trader is to listen to that message, not argue with it. But you didn't listen. You argued. You held a position that the market was clearly telling you to exit. And in doing so, you violated the first law of speculation. Never fight the tape. The tape is the voice of the market. When it speaks, you listen. When it says down, you get out or you go short. You don't hope. You don't average down. You don't wait for it to agree with your analysis. You act on what is, not what should be. This is the invisible theft I mentioned at the beginning. You're stealing from yourself. Every time you hold a loser and cut a winner, every time you trade out of boredom or impatience, every time you force a trade because you feel like you should be doing something, every time you let your ego override your discipline, you're taking money out of your own pocket and handing it to the patient, disciplined traders who have learned to do the opposite. Now, let me tell you a story from my own experience that illustrates this principle so clearly that it still gives me chills decades later. It was 1906, and I was watching Union Pacific. I'd been studying it for weeks. Everything about the company looked magnificent. The economy was strong. The railroads were essential infrastructure. The management was competent. The earnings were growing. Every metric, every indicator, every fundamental analysis pointed to higher prices. So I bought, and I bought heavy. Because I wasn't just confident, I was certain. I had done the work. I knew this company inside and out. I knew what it was worth, and I knew the market was going to recognize that value. The stock started to fall. Not dramatically at first, just a steady grinding decline. A point today, 2 points tomorrow, half a point the day after that. And each day, I would review my analysis. I would check the fundamentals. And every time, I would confirm to myself that nothing had changed. The company was still solid. The business was still strong. The market was simply being irrational. So I did what seemed logical at the time. I bought more. The price was lower, which meant it was a better value. I was getting the same stock at a discount. This made perfect sense to me. I was averaging down, turning a losing position into what I believed would eventually be a massive winner when the market finally came to its senses. The stock kept falling. My position got larger. My losses got deeper. And here's what I couldn't see at the time. What I only understood years later after losing and rebuilding fortunes multiple times. The tape was screaming at me. Every single day, the market was telling me in the clearest possible terms that I was wrong. Not wrong about the fundamentals, wrong about the timing, wrong about what the market wanted to do right now. Price is truth. Volume is truth. The tape is truth. Everything else, news, fundamentals, analysis, opinions, is just noise. And I was drowning in noise while ignoring truth. The market didn't care about my research. It didn't care that I was right about the company's value. It only cared about one thing: supply and demand. And in that moment, supply was overwhelming demand. I lost a fortune on Union Pacific. Not the last fortune I would lose, but one of the most painful because it taught me something I desperately didn't want to learn. Being right doesn't matter. Timing matters. The market's behavior matters. What's actually happening matters infinitely more than what should happen according to logic or analysis or research. When I finally exited that position months too late, after the damage was catastrophic, I made myself a promise. I would never again fight the tape. I would never again hold a position that the market was clearly telling me to abandon. I would never again confuse my analysis with reality. From that moment forward, I would trade what I saw, not what I thought. And that decision, that fundamental shift in how I approached the market, made me more money over my lifetime than any brilliant analysis ever did, because I stopped trying to be smarter than the market and started trying to be aligned with the market. I stopped predicting and started observing. I stopped fighting and started flowing. This is the first major lesson I want you to take from this video. The market doesn't need to cheat you. You're already doing that to yourself. Every time you hold a loser because you can't admit you're wrong, every time you average down on a falling stock, every time you marry a position and refuse to divorce it even when it's clearly destroying you, you're participating in your own wealth destruction. And the beautiful, terrible thing is that this pattern is so predictable that it might as well be a law of nature. The market has been transferring wealth from the stubborn to the flexible, from the opinionated to the observant, from the emotional to the disciplined. For as long as markets have existed, it's not a conspiracy. It's an emergent property of how human psychology works. Think about it this way. What makes you hold a losing position? Fear. Fear of being wrong. Fear of admitting failure. Fear of taking a loss. These are deeply human, deeply understandable emotions. Every trader feels them. I felt them. You feel them. The difference between traders who survive and traders who blow up is not that successful traders don't feel fear, it's that they act despite the fear. They take the loss. They admit they were wrong. They preserve their capital to trade another day. Now, let me show you the other side of this pattern, because it's equally destructive. You buy a stock and it immediately goes in your favor. You're up 5%, then 10%, then 15%. You're feeling good. You're feeling smart. This is what you came to the market for. This is vindication. This is proof that you know what you're doing. And then something shifts in your psychology. You start to feel fear again. Not the fear of being wrong, the fear of losing your gains. You've made money, and now you're terrified of giving it back. What if it reverses? What if you watch your profit disappear? What if you end up regretting not taking the gain when you had it? So you sell. You take your 15% profit, and you feel good about it. You tell yourself you're being disciplined, taking profits while they're there. And then you watch helplessly, agonizingly as the stock continues to rise. 20%, 30%, 50%. The stock you sold goes on to do exactly what you thought it would do, but you're not in it anymore because you couldn't tolerate the discomfort of holding a winner. This is the other half of the wealth destruction pattern. Cut your winners too early, hold your losers too long. It's the inverse of what works. What works, what has always worked, what will always work is the exact opposite. Cut your losses immediately and let your profits run. But that's not what we do naturally. Our psychology is wired exactly backward for trading. We evolved to avoid losses more strongly than we seek gains. We evolved to feel the pain of loss more acutely than the pleasure of gain. We evolved to be risk-averse when we have something and risk-seeking when we're trying to recover something we've lost. Every single instinct we have is precisely wrong for trading. The market knows this. Not consciously, the market isn't a person. But the structure of markets, the patterns that emerge from millions of participants making decisions, creates a kind of selection pressure. Traders who can override their instincts survive. Traders who can't, don't. It's that simple. The market doesn't need to be rigged because human nature is the rig. So when you ask, is the market rigged against me? What you're really asking is, why do I keep making the same mistakes? And the answer is, because no one ever taught you what mistakes you're making. No one ever showed you the psychological machinery that's running in the background, making your decisions for you, sabotaging your results. Let me give you another example. This one about timing. I've been right about market direction and lost money. I've been wrong about market direction and made fortunes. This sounds like a contradiction, but it's not. It's the difference between analysis and execution, between being right and being profitable. In 1929, I could see the crash coming, not the exact day or the exact magnitude, but I could see that the market was overextended, over-optimistic, overdone. The signs were everywhere. Taxi drivers were giving stock tips. Shoeshine boys had portfolios. Everyone was in the market. Everyone was making money. Risk had been completely forgotten. This is always the sign that the end is near. So I started shorting. I put on positions betting that the market would fall. And initially, I lost money, because the market didn't crash immediately. It kept going up. My analysis was correct, but my timing was early. And in the market, early is the same as wrong. I was paying the price for being ahead of the move. But I had learned by then. I knew that being right about the destination doesn't matter if you can't survive the journey. So I kept my positions small enough that the pain was tolerable. I didn't force it. I waited. And when the market finally did turn, when the crash I knew was coming finally arrived, I was positioned perfectly. I made millions while the rest of the world was losing everything. The lesson here is critical. Timing is everything. Direction is nothing. You can have perfect analysis and terrible timing and you'll go broke. You can have mediocre analysis and excellent timing and you'll make a fortune. The market doesn't reward correct predictions. It rewards correct positioning at the correct time. And how do you develop timing? Not through analysis, not through prediction, through observation, through watching the tape, through learning to read price and volume, learning to sense when momentum is building or fading, learning to feel when the market is ready to move versus when it's just chopping around going nowhere. This is a skill that almost no one teaches because it can't be reduced to a formula. It's not mechanical. It's not algorithmic. It's observational and intuitive. You develop it the same way you develop any skill, through practice, through repetition, through paying attention to what works and what doesn't. I spent years just watching the market, not trading every day, watching, studying how prices moved, how volume preceded moves, how momentum built and collapsed, how the market behaved at support and resistance, how patterns repeated across different stocks and different time frames. I was training my eye to see what was actually happening instead of what I hoped would happen. And this training, this discipline of observation, made me more money than any amount of analysis ever could, because I learned to wait. I learned to let the market come to me. I learned to only trade when conditions were optimal and to sit on my hands the rest of the time. Most traders do the opposite. They trade constantly. They're in the market every day, making moves, taking positions, staying active. They mistake activity for productivity. They feel like if they're not doing something, they're missing out. And this compulsion to act, this inability to sit still and wait for the right pitch, destroys more traders than any market manipulation ever could. The market is open every day, but opportunities that meet your criteria, setups that offer real edge, situations where the risk-reward is genuinely favorable appear rarely. Maybe once a week, maybe once a month, maybe less. The rest of the time, the correct action is nothing. No position, no opinion, just observation. But doing nothing feels terrible. It feels like you're not a trader. It feels like you're missing out on moves, on opportunities, on potential profits. So you force trades, you lower your standards, you convince yourself that this setup is close enough, good enough, worth taking a shot. And most of the time, you're wrong. Most of the time, forced trades are losing trades. I learned to embrace boredom. I learned that patience is not passive, it's the most active, most difficult, most valuable thing a trader can practice. Patience is you fighting every instinct to do something, to be involved, to take action. Patience is you sitting there watching opportunity after opportunity pass by because they don't meet your criteria. Patience is you waiting days, weeks, sometimes months for the setup you know how to trade. And when that setup finally appears, when all your criteria align, when the market is clearly showing you what it wants to do, that's when you act. Decisively, confidently, with size, because you've been patient, you've preserved your capital, and now you have a legitimate edge. This is what separates professional speculators from gamblers. Gamblers are in the market constantly, hoping to get lucky. Professionals are in the market rarely, waiting for situations where luck isn't required. Gamblers need the market to do something extraordinary. Professionals just need the market to do what it's clearly already doing. Now I want to talk about something that nobody wants to hear, but it's possibly the most important thing I'll say in this entire video. The crowd is always wrong at the extremes. Always. Without exception. This isn't opinion. It's not cynicism. It's observable fact repeated across every market cycle in history. Let me paint you a picture. It's 1928. You walk into a brokerage house. The room is electric with energy. Men are shouting, celebrating, counting their money. Everyone has a story about the fortune they made this week. Everyone knows someone who quit their job to trade full-time. Your barber is talking about his portfolio. Your neighbor just leveraged his house to buy more stocks. The newspapers are full of articles about the new era of permanent prosperity. This is the moment when the trap is perfectly set, not by conspirators, by mass psychology. The market has been rising so long, so consistently, that an entire generation has forgotten that stocks can go down. Risk has been erased from consciousness. Caution is mocked. Anyone who suggests being careful is told they're missing out on the opportunity of a lifetime. And underneath all of this optimism, underneath all of this confidence, there's a simple mathematical reality when everyone who's going to buy has already bought, when the last fool has entered the market, when there's no one left on the sidelines with capital to deploy, the only direction left is down. This is what happened before 1929. It's what happened before 2000. It's what happened before 2008. It's what will happen before the next crash. The pattern never changes because human nature never changes. Markets go up until everyone believes they can only go up, and then they collapse. The crowd isn't stupid. The crowd isn't made of fools. The crowd is made of normal, intelligent people who are responding rationally to what they've experienced. If you've watched stocks go up for 5 years straight, it's perfectly rational to believe they'll keep going up. If everyone around you is making money, it's perfectly rational to want to participate. If the experts are saying this time is different, it's perfectly rational to believe them. But markets don't care about rational. Markets care about supply and demand. And when everyone is fully invested, when optimism is universal, when fear has been completely replaced by greed, that's when supply overwhelms demand. That's when the professionals, who have been waiting for this moment, start selling. And that's when the crowd, late to arrive and slow to recognize what's happening, gets destroyed. I watched this happen in 1929. I watched men lose everything, their savings, their businesses, their homes, their families. And almost to a man, they believed they were victims of manipulation. They believed the market was rigged. They believed some evil force had stolen their money. But that's not what happened. What happened is they participated in a mania. They ignored every warning sign. They bought at the top because everyone else was buying, and they held all the way down because they couldn't accept that the party was over. The market didn't cheat them. The market taught them. But they refused to learn the lesson. They refused to accept that they had violated basic principles of speculation. They refused to see that their losses were the predictable, inevitable result of joining the crowd at precisely the wrong moment. This is why I learned to do the opposite of the crowd. Not to be contrarian for its own sake, contrarianism is just another form of opinion. But to recognize when mass psychology has reached an extreme, and to position myself accordingly. When everyone is bullish, I become cautious. When everyone is bearish, I start looking for opportunities. When the crowd is panicking, I'm patient. When the crowd is euphoric, I'm protective. This doesn't mean I'm always right. It means I'm never caught in the stampede. It means I don't get swept up in manias or panics. It means I maintain my independence, my clarity, my ability to see what's actually happening instead of what everyone says is happening. And here's the really important part. The market is designed not by people, but by the mathematical properties of how markets work to extract maximum wealth from maximum people at the moment of maximum optimism. That's not a conspiracy. That's emergence. That's what happens when you have millions of participants making emotional decisions based on recent experience. The professionals, the people who survive decade after decade, understand this. They understand that the market is primarily a psychological game. The prices, the charts, the fundamentals, those are just the scoreboard. The real game is whether you can remain disciplined when everyone around you is losing their minds, whether you can be patient when everyone else is frantically active, whether you can think independently when the pressure to conform is overwhelming. Most people can't. Most people join the crowd because being part of the crowd feels safe. It feels validating. If everyone is doing the same thing, it can't be wrong, right? Wrong. In markets, doing what everyone else is doing is the surest path to mediocrity at best and ruin at worst. I learned to be comfortable being alone. I learned to trust my own observations more than collective opinion. I learned that the time to buy is when everyone is selling in panic, and the time to sell is when everyone is buying in euphoria. This sounds simple. It's incredibly difficult to execute, because it requires you to act against every social instinct you have. But that's the price of success in markets. You have to be willing to stand apart. You have to be willing to be wrong in the short term to be right in the long term. You have to be willing to look foolish while everyone else is celebrating their brilliance, knowing that in 6 months or a year, the situation will reverse, and you'll be the one still standing while the crowd is licking their wounds. Now let me tell you about the most important lesson I ever learned, the one that saved my life and rebuilt my fortune after I lost everything. Cut your losses immediately and let your profits run. This sounds obvious. Everyone nods when they hear it, and almost no one actually does it, because doing it requires killing your ego every single day. When you enter a trade, you have a thesis. You believe something is going to happen. If the market immediately proves you wrong, if price goes against you, your ego engages. Your ego says, no, I'm right. The market just doesn't see it yet. Your ego says, give it time, it'll come back. Your ego says, this is just temporary. My analysis is sound. Your ego is your enemy. Your ego will bankrupt you, because the market doesn't care about your thesis. It doesn't care that you did research. It doesn't care that you're smart. The market is telling you in real time, through price action, whether you're right or wrong. And if you're wrong, the only correct action is to get out immediately. Not tomorrow, not after you check the news, not after you see if it bounces. Immediately. Because small losses don't hurt you. Refusing to take small losses, letting them turn into medium losses and then catastrophic losses, that's what destroys trading accounts. I learned to treat losses like business expenses. Unavoidable. Expected. Part of the cost of doing business. I didn't emotionalize them. I didn't let them mean anything about me as a person or as a trader. I was wrong about this particular trade. That's it. That's all it means. So I take the loss, preserve my capital, and move on to the next opportunity. But here's the other half of the equation, the part that builds fortunes. When you're right, when the market is confirming your position by moving in your favor, you have to let it run. You have to fight the urge to take profits too early. You have to sit there, watching your unrealized gains fluctuate, tolerating the discomfort of potentially giving back some of your profit, because that's the only way to capture the big moves. Big moves are rare. Most trades are small wins or small losses. But the trades that make your year, the trades that build real wealth, are the ones where you're right about a major move and you have the discipline to ride it. If you cut those winners early because you're afraid of losing your profit, you eliminate the entire reason for trading in the first place. Think about the mathematics. If you take 20 trades and 15 of them are small losses, but 5 of them are big wins, you can still be wildly profitable, but only if you actually capture those big wins. If you cut them early, if you take small profits on your winners and large losses on your losers, the mathematics guarantee that you'll lose money over time. This is why I developed a rule that I never violated. I would take my losses at a predetermined point, but I would let my profits run until the market told me to get out, not until I felt like I had enough profit, not until I was afraid of giving some back, until the market told me, through price action and volume, that the move was over. Sometimes this meant giving back 20 or 30% of my unrealized gain. That hurt. But it meant I captured the other 70 or 80% of moves that some traders took 10% of. Over time, over hundreds of trades, this asymmetry, small losses, large wins created enormous wealth. But you can't do this if you're emotional. You can't do this if you're attached to any individual trade. You have to be completely neutral. When you're losing, you take the loss without drama. When you're winning, you stay in the position without fear. You execute your system mechanically without letting your feelings about money interfere with your decisions. This is what I mean when I say trading is primarily a psychological game. The strategy is simple. Cut losses, let winners run, wait for high probability setups, don't force trades. The strategy is so simple a child could understand it. But executing that strategy while your account balance is fluctuating, while you're feeling fear and greed and hope and regret, that's the hard part. That's what almost no one can do consistently. So the question becomes, how do you develop that psychological discipline? How do you override decades of conditioning that tells you to hold losers and cut winners? How do you become the kind of trader who can execute a simple system without letting emotions sabotage your results? The answer is practice. Intentional, deliberate practice. You have to train yourself the same way you'd train for any other skill. And the first step in that training is awareness. You have to see what you're doing. You have to catch yourself in the act of making emotional decisions. This is why I recommend keeping a journal, not a trade journal where you record your entries and exits, although that's useful too, but a psychological journal where you record what you were thinking and feeling before, during, and after each trade. Before you enter a trade, write down your thesis. Write down why you're taking this trade. Write down what would make you wrong. Write down where you'll exit if the trade goes against you. This forces clarity. It forces you to articulate your reasoning, and it creates a record you can review later to see if your decision-making process was sound. During the trade, write down what you're feeling. Are you anxious, excited, impatient, fearful? These emotions are data. They tell you when you're about to make a mistake. If you're feeling anxious about a losing position, that anxiety is telling you to exit. If you're feeling impatient with a winner that's consolidating, that impatience is telling you that you're about to cut your winner too early. After the trade, write down what happened versus what you expected. If you were right, why? What did you see that others missed? What was your edge in this particular situation? If you were wrong, why? What did you miss? What could you have seen earlier? What will you do differently next time? This journaling practice does something extraordinary. It externalizes your psychology. Instead of these thoughts and feelings swirling around in your head where you can't see them clearly, you put them on paper where you can examine them objectively. And over time, you start to notice patterns. You notice that you always get impatient after 3 days of consolidation. You notice that you have a tendency to chase price after it's already moved 10%. You notice that you hold losers in your largest positions but quickly cut small winners. Once you see these patterns, once they're visible to you, you can start to interrupt them. But you can't interrupt what you don't see. Most traders never develop awareness of their psychological patterns. They just keep repeating the same mistakes over and over, wondering why the results don't improve. The journal makes the invisible visible, and visibility is the first step toward change. The second practice I recommend is tape reading without trading. Pick one stock or one index. For 30 days, just watch it. Don't trade it. Don't have an opinion about it. Just observe. Watch how it moves. Study the relationship between price and volume. Notice when momentum is building. Notice when it's fading. Notice how it behaves at support and resistance levels. What you're training is your ability to see what is instead of what you think should be. You're learning to read the market's language. Price goes up on increasing volume, that's the market speaking. Price goes up on decreasing volume, that's the market speaking differently. Price bounces off support message received. Price breaks through support message received. After 30 days of pure observation, without the distortion of having money at risk, you'll start to develop an intuitive sense of market rhythm. You'll start to feel when something is about to change. Not because you're psychic, not because you're special, but because you've trained your pattern recognition system by watching thousands of price bars without the interference of fear and greed. This is what I did for years early in my career. I watched the tape. I studied how prices moved. I learned to read the market's intentions, not through news or analysis, but through behavior. And this skill, this ability to read what's actually happening in real time, gave me an edge that no amount of fundamental analysis could provide. The third practice, and possibly the most important, is the stop-loss covenant. Before you enter any trade, decide where you're wrong. Write it down, not in your head on paper, on your screen, somewhere external and permanent. If price hits that level, you exit. No exceptions. No second guessing. No checking the news to see if there's a reason to give it more room. You get out. This single practice will save you more money than any brilliant analysis. Because the biggest losses, the account-destroying losses, don't come from being wrong. They come from refusing to admit you're wrong. They come from holding a small loss until it becomes a catastrophic loss, because you couldn't face the emotional pain of admitting defeat. Set your stop based on your risk tolerance. 2% of your account, 5% at most. The exact number doesn't matter as much as the commitment to honor it. When you set a stop and actually follow through on exiting when it's hit, you accomplish two things. You limit your downside risk, and you preserve capital to trade another day. And in the market, survival is everything. You can be wrong 9 times in a row. If you keep your losses small, you're still in the game. But if you take one catastrophic loss because you refuse to use a stop, you're done. Game over. It doesn't matter how smart you are or how good your analysis is. If you blow up your account, you can't trade anymore. The covenant is this. You promise yourself, before you ever enter a trade, that you will honor your stop, no matter what story your mind tells you. Your mind will generate 1,000 reasons to give the trade more room, more time, and more patience. Every single one of those reasons is your ego trying to avoid the pain of being wrong. Every single one will cost you money. Trust the stop. Honor the stop. Let it save you from yourself, because that's what it's designed to do. It's not about the market. It's about protecting you from your own worst impulses. The fourth and final practice is developing entry criteria and refusing to trade unless all criteria are met. This sounds simple. It's brutally difficult, because the market will constantly tempt you with trades that are close enough or pretty good or might work. Let them go. Wait for your pitch. Wait for the setup that meets every single one of your criteria. This discipline transforms trading from gambling to calculated risk-taking. Most traders lose because they take too many trades. They're constantly in the market, chasing, forcing, hoping. The profitable traders take far fewer trades, but each trade has real edge, real reason, real setup. Define what your edge is. Maybe it's trending markets where momentum is clear. Maybe it's reversal setups after overextension. Maybe it's breakouts from consolidation. Whatever it is, define it clearly. Write down the specific conditions that must be present, then have the discipline to only trade when those conditions align. This means most days, most weeks, You do nothing. You watch. You wait. You preserve your capital and your mental energy for the opportunities that actually offer favorable odds. And when those opportunities appear, when all your criteria align, you act decisively, with confidence, with size. This is the difference between traders who survive long-term and traders who blow up. Survivors are selective. They understand that not every move requires their participation. They understand that preservation of capital is more important than catching every trade. They understand that patience isn't passive, it's the most active, most valuable thing you can practice. If I could give you only one piece of advice, it would be this: trade less, wait more. Only enter positions when conditions are clearly favorable. And when conditions aren't favorable, do nothing. Watch, study, prepare. But don't risk capital just because you feel like you should be doing something. The market will always be there tomorrow. Your capital won't be if you waste it on mediocre setups. Every trade you don't take is a trade you can't lose on. Every day you preserve your capital is a day you remain in the game, ready for the opportunity that actually matters. Now, I want to address something directly because I know some of you are thinking it. But Jesse, what about the algorithms? What about high-frequency trading? What about the institutional advantages? Surely those things make it harder for the average person to succeed. And my answer is, sure, those things exist. The market structure today is different than it was in my time. Technology has changed how orders are executed, how information flows, how quickly prices can move. But none of that changes the fundamental game. None of that changes human psychology. None of that changes the fact that most people lose money for psychological reasons, not technological ones. The algorithms aren't taking your money because they're faster than you. They're taking your money because they're more disciplined than you. They execute their system without emotion. They cut losses immediately. They don't override their rules because of hope or fear or ego. They do exactly what I've been describing in this video. They follow a system consistently, without deviation, regardless of how they're feeling. You can't compete with algorithms on speed, but you don't need to, because speed isn't edge. Discipline is edge. Patience is edge. The ability to wait for your specific setup while everyone else is frantically trading, that's edge. The ability to hold a winner while your emotions are screaming at you to take profits, that's edge. The game hasn't changed as much as you think. It's still about psychological mastery. It's still about discipline over impulse. It's still about observation over prediction. The tools are different. The speed is different. But the core challenge, can you master yourself, is identical. I've watched markets for over a century of history. I've seen every possible market structure, every type of boom and bust, every variety of mania and panic. And through all of that, one thing remained constant. The patient, disciplined, observant trader survives and prospers. The impulsive, emotional, opinionated trader gets destroyed. That was true in 1900, it's true today. It will be true in 2100. So stop blaming the structure. Stop looking for external excuses. The game is winnable. It's always been winnable, but only for those willing to do the internal work of mastering themselves. And that brings me to the final, most important point I want to make in this video. The market is not your enemy. I need you to really hear this, because it's the key to everything. The market is not plotting against you. It's not designed to steal from you. It's not rigged by evil institutions or manipulated by shadowy cabals. The market is simply a mechanism for price discovery, a way of determining what something is worth right now based on supply and demand. Your real enemy is your untrained mind, your ego, your impatience, your fear, your greed, your need to be right, your inability to admit when you're wrong, your compulsion to act when you should wait, your tendency to cut winners and hold losers. Every single one of your losses can be traced back to a failure in psychological discipline. And here's why this is actually good news. You can fix yourself. You can't fix the market. You can't control institutions or algorithms or other traders. But you can control yourself. You can train your mind. You can develop discipline. You can build patience. You can learn to see clearly, instead of through the distortion of emotion. This is the real game. This is what separates those who survive from those who are consumed. Not intelligence, not information, not some secret strategy. Just the ability to execute a simple, sound system consistently over time without letting emotions sabotage your results. Every great trader I've known, and I've known a few, had this quality. They weren't necessarily the smartest. They weren't necessarily the most connected. They weren't necessarily the fastest or the most aggressive. But they had complete mastery over themselves. They could sit still when sitting still was required. They could act decisively when action was required. They could take a loss without drama and hold a winner without fear. This self-mastery is developed, not inherited. You're not born with it. You build it through practice, through repetition, through making mistakes and learning from them, through keeping a journal, through watching the tape, through honoring your stops, through waiting for your criteria to align, through doing all the boring, unglamorous work that no one wants to do because it doesn't feel like progress. But it is progress. It's the only progress that matters. Because once you develop psychological discipline, once you can execute your system without interference from emotion, you have an edge that can never be taken from you. Market conditions will change. Technology will evolve. But your discipline, your patience, your clarity, those are permanent. So when you ask, is the market rigged against me? What you're really asking is, can I win at this game? And the answer is yes. Absolutely yes. But only if you're willing to change how you think about trading. Only if you're willing to stop looking for external enemies and start examining internal weaknesses. Only if you're willing to do the work that most traders refuse to do. The market doesn't need to be rigged. You're already defeating yourself with perfect efficiency. But the moment you recognize that, the moment you see the machinery that's been extracting money from your account, you can start to dismantle it. You can start to trade differently. You can start to think differently. You can start to be the trader who profits from other people's emotions instead of being the emotional trader who's funding someone else's discipline. This is the transformation I want for you. Not overnight success, not a magic strategy, not a secret formula. Just the clear recognition that the game is winnable, the opponent is yourself, and the solution is discipline. I've made fortunes and lost fortunes. I've stood at the top of the financial world and I've fallen to the bottom. And through all of that, the one thing I learned with absolute certainty is this: the market is not your enemy. Your untrained mind is. The tape tells the truth. Your ego tells lies. Wait for your pitch. Honor your stops. Let profits run. Cut losses immediately. And remember, always remember, you're not competing with institutions. You're not competing with algorithms. You're competing with yourself. And that's the only competition that matters. Every loss you've ever taken was a failure of discipline. Every blown account was a failure of self-control. Every missed opportunity was a failure of patience. The enemy isn't out there in the market. The enemy is in here, in your own psychology. And until you accept that, until you really see it clearly, you'll keep losing to a game you don't even know you're playing. But once you see it, once you understand the machinery, everything changes. You stop being a victim. You stop blaming external forces. You stop making excuses. And you start doing the work, the real work of becoming a disciplined trader. This work isn't glamorous. It won't make you rich overnight. It won't feel like progress most of the time. But it's the only work that matters. Because the market will reward discipline forever. It will punish emotion forever. And you get to choose which side of that equation you're on. I've given you the map. I've shown you where the traps are. I've explained the psychological machinery that's been defeating you. Now it's your job to do something with this information. You can keep trading the way you've been trading, and keep getting the results you've been getting. Or you can commit to the difficult, unglamorous work of mastering yourself. Keep a journal. Watch the tape. Honor your stops. Wait for your criteria. Trade less. Observe more. Cut losses immediately. Let winners run. Do these things consistently, without deviation, regardless of how you're feeling. And I promise you, your results will transform. Not because the market has changed, because you have. The market will always be there, expressing supply and demand, moving prices up and down based on the collective decisions of millions of participants. Your only job is to align yourself with what's actually happening instead of what you wish was happening, to observe instead of predict, to flow instead of fight, to be disciplined instead of emotional. This is the path. This is the only path. There are no shortcuts. There are no secrets. There's just the simple, difficult work of developing psychological discipline. And every single person watching this video has the capacity to do that work. You just have to decide that you're willing to. So let me ask you directly, are you willing? Are you willing to look in the mirror and admit that you've been your own worst enemy? Are you willing to stop blaming the market and start mastering yourself? Are you willing to do the boring, unglamorous work of keeping a journal and watching the tape and honoring your stops? Because if you are, if you're truly willing to commit to this path, then I can tell you with absolute certainty, you can succeed at this game. Not because it's easy, not because you're special, but because the game rewards the very things you can control: discipline, patience, observation, psychological mastery. The market is not rigged against you. The market is a mirror. It shows you exactly who you are, your discipline or lack thereof, your patience or lack thereof, your ability to see clearly or your tendency to see through the distortion of emotion. Every trade is feedback. Every loss is a lesson. Every win is confirmation that you're doing something right. So take the lesson. Learn from the feedback. Stop fighting the mirror and start using it to see yourself clearly. Because that's the only edge that matters. That's the only advantage that can never be taken from you. Self-knowledge, self-mastery, self-discipline. I've shown you the way. I've given you the principles. Now it's up to you to walk the path. And I'll tell you right now, most people won't. Most people will watch this video, nod along, say, that makes sense, and then go right back to trading exactly the way they've been trading. They'll keep cutting winners and holding losers. They'll keep forcing trades and ignoring their stops. They'll keep blaming the market instead of examining themselves. Don't be most people. Be the exception. Be the trader who actually does the work. Be the trader who keeps the journal and watches the tape and honors the stops. Be the trader who waits for optimal conditions instead of forcing mediocre trades. Be the trader who cuts losses immediately and lets winners run. Be the trader who masters themselves, because that's what this is really about. Not making money that's just the scoreboard. This is about becoming the kind of person who can execute a plan under pressure, who can admit when they're wrong without it meaning anything about their worth as a person, who can sit still when sitting still is required and act decisively when action is required, who can observe reality clearly instead of through the filter of hope and fear. That person, that disciplined, patient, clear-seeing person, that person wins. Not every trade, not every day, but over time, consistently, sustainably, because they're playing a different game than everyone else. They're not trying to predict the future or outsmart the market. They're just aligning themselves with reality and letting the mathematics of small losses and large wins do the work. This is what I learned over a lifetime in the markets. This is what cost me fortunes to figure out, and I'm giving it to you now, clearly and directly, so you don't have to learn it the hard way. The market is not rigged, but it is ruthlessly honest. And honesty, as it turns out, is the only edge you'll ever need. If this resonated with you, if something in this video shifted how you see trading, I want to hear from you. Leave a comment and tell me which of the 3 laws you struggle with most. Is it fighting the tape, holding positions the market is telling you to exit? Is it cutting losses, admitting when you're wrong and getting out fast? Or is it patience, waiting for optimal conditions instead of forcing trades? Tell me where you struggle, because awareness is the first step toward change. And if you want more of this, if you want truth, even when it's uncomfortable, if you want principles instead of promises and discipline instead of hope, subscribe to this channel, because I'm going to keep telling you what you need to hear, not what you want to hear. I'm going to keep showing you the machinery that's extracting money from your account and how to dismantle it. I'm going to keep teaching you the lessons that took me a lifetime to learn. The market will be here tomorrow. Make sure you are too. Cut your losses. Let your winners run. Wait for your pitch. Honor your stops. Master yourself. And remember, the game isn't rigged, but it is ruthlessly honest. And honesty is the only edge that matters.